So with Palantir having a massive run up after earnings and basically YouTubers being all over the map, some of them saying sell it, some of them saying buy more, go all in, and everything else in between, making the wrong decision in this scenario can absolutely crush you as an investor. I mean, last year, if you just waited on Palantir after it had a big run up, it would just kind of come right back down, kind of rinse and repeat. I mean, you just run up, come back down, run up, and come back down. That's what happened the entire year last year. But now things have changed since they finally turned that corner to profitability and are set up for a great run moving forward. So do you buy because it's going to continue to go up as they continue to crush it quarter after quarter and get closer and closer and closer to the S&P 500 inclusion? Or do you wait because for more than a year now, it has run up and then it just crashed right back down in spectacular fashion? So let's discuss this, and I'll give you my plan for Palantir moving forward as well, right after you gently tap that like button and consider subscribing too. It's super easy to do if you like the truth without the hype. So how do you decide what exactly to do in this scenario? I mean, it seems to be a scenario that's going to happen. And honestly, as we kind of come out of this, whatever the heck we've been in for the past year and a half or so, you're going to have to make this decision more and more often. So we need to discuss what exactly do you do in this scenario, because you're going to see this scenario a lot more moving forward. Well, first, I mean, you could sell and see if it goes lower. I mean, there's a lot of YouTubers out there telling you that's the place to go. That's exactly what you need to do, and it is a viable strategy. But for me, I got a couple of questions for you, right off the bat here, before we even get started. One, you got to make a decision on when to sell. And then two, what exactly is your entry point back into the stock after you sell, especially when I hold it? Now, if it's just a trade and you don't want, you're not holding it for any length of time, okay, makes sense. I understand exactly where you're going there. But if this is a long-term buy and hold for you, and for me, I'm a long-term buy and hold investor, and this is the stock I want to hold for the long term, how exactly am I going to get those two things right? What exactly is your plan for that? What are you using as a measure for when to sell and then when to buy, back in? Because remember, you want to own it long term. Remember, if you get that wrong, you're screwed. I mean, that's the honest truth. I don't know how else to say that. It's one of the major reasons why I don't trade in the first place, because not only do I got to get the stock right, which of course is very, very important, probably the most important overall, because obviously even if you get the entry price wrong, a great stock can help you out over time. My Apple example is the best one I got. I mean, I entered 40% above where it eventually crashed down to, and it hasn't mattered long-term one bit over the course of the past 20 years. So, that's kind of the first thing you got to do, is you got to kind of try to get the entry point right if you're going to trade it this way. And then two, what's your sell point? And then three, what exactly is your entry point again down here, whenever it goes lower, if you think it's going to go lower? And what happens if you buy it and then it dips lower than that, right? So let's say your sell point is, I don't know, 950, whatever the case is. And then now all of a sudden it drops down. You want to buy it back at, let's say, 850. Well, what if you buy back at 850 and it drops down to 750, 25. What happens then? Are you going to then sell and take your loss and try to get it lower to try to make up for the initial loss because you didn't time that bottom in the first place? It, to me, just adds a lot of complexity, a lot of questions, and it's just not something I'm willing to do. And it's a very, very tough thing to do. I don't want to try to get it right multiple times. And I've got to get all those events right, because if you get them all wrong, and let's just say you decide to sell at $9.50, but then Palantir goes to, let's say, $11, $12, something like that. Now, not only did you sell, sure, you made some money, but now you got to overpay for the stock, and you end up, the wash ends up being you're still in a negative. You still lost. You would have been better off just holding. So for me, instead of having a bunch of different variables that work against me and that I have to get right, it doesn't make sense to me as a long-term buy and hold investor to sell and then try to get back in. To me, it makes a lot more sense to solve my money problem and figure out how I can just buy the dip if it happens to dip down. That's great if, the folks that are out there saying sell it are right and it does dip back down to $8, $7, wherever it ends up going. Awesome. That just means I get to continue to add and continue to build out my position at a cheap price. Now, I'm not saying one is right or wrong, but for me, if I sell, I got to take a 40% tax hit. Then on top of that, I have to, try to get those entry and exit, or I guess at that stage, it would be the new entry point right again, and then kind of rinse and repeat repeatedly. And it's just not something I want to do. I don't want to have that sort of stress in my life. And more importantly, it's not the strategy that I'm implementing. So it's a very, very different strategy. It makes sense for some, doesn't make sense for others. And in my case, that doesn't make sense for me. Now, the second thing you can do, and that I've heard some folks talking about, is you can just buy and hope that it goes up. I mean, hey, who needs due diligence or, a strategy or anything else just buy and hope that it goes up, right? I mean, that's a great strategy, isn't it? That's exactly what happened in 2021 and got so many folks in trouble because they were basically playing the lottery mentality. It was just throw your money there and hope that it runs up and hope that it just, goes. You're using hopium as your reason for making a lot of money in the stocks. And I know back then it was like everything's going to 100x in 2 weeks and crazy narratives like that. But unfortunately, even though folks know, hey, all right, 100x in the week probably isn't, very, isn't a great way to invest and isn't going to happen. The idea that you're still going to invest once and just it's going to go to the moon at some point in time later on, or progressively build to the moon later on and never do anything else is also kind of a fallacy as well. That's kind of a hangover from that 2021. You've got to do due diligence. You've got to understand what you own. You've got to get those price targets right, or at least understand where over and undervalued is. So that way you know when to put money in, more money in. If you're just straight DCAing, it doesn't matter, which of course it's really, really hard to beat a straight DCA. It's a great strategy. But in general, that's not a good strategy to just throw money into it and just hope. I mean, especially if you don't even know what you own in the first place, just because I'm talking about it or somebody else is talking about the stock or somebody else likes the stock or, somebody on an article or on TV likes the stock. It's not a good reason to own the stock. You've got to do your due diligence and you've got to understand what you're buying in the first place and have a strategy for how you're going to buy, more importantly, as you get to that point where you are ready to buy and execute on those buys on that particular stock. So if those two are kind of the two that you kind of hear the most, but they're not really the right way to handle them, at least in my opinion. So let me kind of lay out here for you exactly how I plan on handling this scenario with Palantir stock specifically. Now, to be upfront and honest with you guys, this is just kind of something that I don't think you need to just listen to me and blindly follow me or blindly follow anyone else for that matter. You can kind of take pieces of this, take pieces of what somebody else does, but you have to create your own plan. You have to create your own strategy. Hopefully this just kind of gives you a framework to work off of or some ideas, but you got to kind of create your own there because we have different risk tolerances. We have different, ability to buy. Our portfolios are made up differently. I probably have a much different Palantir position than you do at this stage. So all those sort of things kind of all factor into your plan and what you want with the stock. Heck, our convictions can be completely different in stock. You may like Palantir. I may love Palantir, or you may think Palantir is the next, Apple, Tesla, whatever. And I may think it's just, going to be a great stock long term, but maybe not to those levels. Who knows where all those things lie in between? But that absolutely shows the importance of creating your own plan and creating your own way of moving forward with this. So don't take this as a hard and fast rule or you got to do it this way or anything else like that. Kind of create your own and just kind of understand, hey, this is kind of what I'm looking at. This is the reasons why, and this is what I'm doing moving forward. So the first thing that I would do is I would simply zoom out on the stock, guys. Look, pull that stock price out and take a look at the Palantir stock over the course of its history. Don't get so focused in on the moment and the short-term movements and the daily charts and the weekly charts to where you kind of miss where are we at in the bigger picture here. And that kind of lends right there to the second piece, which is go ahead and make those projections out, those 3-year projections out there and where you kind of think the stock's going to be in those 3 years and kind of put that there in the map. So, kind of you just like zoomed out and then you kind of, hey, here's the half that, the history, here's the future. And then you're able to sit down and look at it and go, all right, where are we at in relation to all that? So that way you kind of have a full picture of where the stock is. Now, this last piece here is probably, well, it's not the last piece, but the second to last piece is to your valuation. Sit down, do a valuation on the stock, and then take a look and see where does that valuation fall on that chart in relation to the stock price, and then create your price target on that based upon that valuation where you want to buy the stock at. And right there, that should be able to show you, where is the stock? Where is fair value and where is your actual price target? And all that is right there, not just in relation to the past, but also into where you see it projecting out there in the future. That gives you a much better picture of what you're looking at. Are you getting a good deal? You're not getting a good deal. If it runs up to 10 or if it falls back down to 8, does it really matter on the scale of that sort of thing? That's why pulling back for me is so important because it gives me that context. It gets me out of the short-term mode, the short-term trading mode, because I'm not a trader. It gets me into that long-term investor mindset to where I'm just like, am I going to care whether it was 8 or 10 bucks? If it happens to run up to 50, are you? I mean, if it hits that all-time high again, 40 something, are you going to care whether or not? Obviously 8 is still better than 10. I'm not saying that at all. But in relation to, when you get up to that price, does it matter? I mean, I can think back when I was buying Apple, of course, split adjusted, it's pennies now, but it didn't matter whether I paid, 30 cents or 60 cents. I mean, again, that's split adjusted. It's not what I paid back then. Doesn't matter because, the stock's at like 180 today. I mean, you're happy either way. Of course, 30 is better than 60 cents. But the point is, you're happy either way because of that long-term picture and where it falls on the chart there. So that helps me kind of gauge my expectations and make sure I'm looking at it from the right mindset, not from the trader's mindset. Now, if you're looking to buy that day because it's in your price range and you're kind of looking at the charts to see where the best entry point is, okay, I can see that. That absolutely makes sense to me. And sometimes I do that too. Aberlo in our group does a great job of posting all the charts and posting the various support and resistance lines on, multiple stocks anytime we're looking to really buy and we know that those are in the buy range. So absolutely, I see that there. But long term, I've got to pull back and look at that bigger picture and understand that, I kind of view it as I'm like a, general on a battlefield here, and I'm kind of moving things around. What's going on in this battle? Well, you're taking some losses here, we're taking some gains over here, but I'm still trying to get that big picture in mind of getting to that ultimate goal that I have for myself with my stocks. That obviously, that's what we teach in our courses and everything else, is creating those goals so that way you have a place. Your investments are all working towards those goals. It doesn't do you any good to have a goal of passive income and then be dealing with a bunch of penny stocks. That's not going to get you to your passive income goal. There's a better way to get there, and making sure that we are buying assets and buying investments and buying stocks that get you towards that goal of passive income, we'll say in this particular example. So once you kind of have that chart and you kind of have everything together, that's when it's time to execute your buys. And there's a lot of ways to do this. And so I'm going to give you exactly how I do it with stocks. And I'll also give you some examples as well from other group members that we have, because there's more than one way. Actually, there's 1,000 ways to do this. You can create your own, but I just want to give you guys some examples here just to kind of get the wheels turning and kind of get your mind thinking of various different ways that will match you, match your plan, match your investing style, match your risk tolerance, things like that. So the big one in our group that I see a lot of is folks basically doing a DCA, except for they keep kind of a separate pot of money here for like extreme dips in stocks. So they kind of have their top 4 or top 3 or top 2 high conviction plays, and they routinely DCA. Let's say it's once a paycheck or whatever, they routinely DCA in. And then with this extra pot over here, one of our stock that kind of is in that top 2, top 4, whatever it is, kind of hits that not just undervalued, but really undervalued. They take money out of that pot and put it over there towards that stock, basically increasing their DCA, doubling up their DCA in that particular stock, whatever the case is. And then during normal times, they just continue right on the normal DCA while they kind of refill their little bonus pot here that they use to buy those extra shares at those cheaper prices. And they kind of do that repeatedly. So that's one way to do it. We got other members that just do a straight DCA. Just every time they get paid, they put money in. It's just, hey, $500 comes in, $1,000 comes in, $2,000 comes in, whatever the case is. And they, hey, all right, money's coming in this week. I got 1 week to spend it. And they spend it over the course of that next week on their top 4 stocks, top 5 stocks, whatever their strategy and their plan is at the time. That's the way that they execute towards that. So there's 1,000 different ways to do it. And there's other ways than that, guys. Those are just kind of the big 2 that kind of pop out at me right at the top of my head here. But there's a lot of different ways to do it. Now, what I tend to do is I tend to do a modified DCA, which means, hey, I set price targets out there that are based upon the valuation in the first place. And then I set my price targets there, and it's different for every single stock. It's not the same percentage. It's not the same everything. Everything depends upon position size and a lot of other factors like that. But anyways, I kind of do a modified DCA so that way, whenever that stock hits my price target, whatever that is, I just DCA into that stock regardless. Hey, you know what? You want to give me, Palantir at $7? Okay, great. And it must drop down to $6.50. Great. I'll buy more. And the lower it gets, the heavier I will continue to buy into that stock. So it's just a modified DCA. I'm basically DCA into it. And then whenever it goes on a big run up, let's say it after earnings, let's say instead of it running up to 10, it would have ran up to 15 or something like that. Cool. All right. I'll back off. I'm not buying any more Palantir. I'm going to focus my efforts over here on these stocks that got beaten down disproportionately for no good reason, right? I mean, Wall Street always seems to be getting stupid. And so that's exactly what you do. And that's over time, that's the way I've built out all my portfolios. Now, yes, once I get a position size full and I have all the shares that I need, then I go into bonus shares, because I'm not going to not buy great stocks that are on great discounts just because my position size is already full if it's a great company. So for me, this is just for me personally, hey, I can have a full position of Tesla, we'll say. Just use it as an example there. Apple. I own way too much Apple. I have too much. However, it's a great company. It's one of the best companies in the world, if not the best company in the world. When it becomes undervalued, which doesn't happen often, it happens, every other year or so, to where it really falls in that real undervalued territory, because I don't just want it fair valued. Because I got plenty. I don't want it undervalued. I want it stupid undervalued. But whenever it hits that stupid undervalued level, which Wall Street gets stupid with every stock at some point in time, I will start buying that stock again, because that's the best use of my capital, and I'm getting just a stupid discount. Now, sometimes that can be frustrating, because a lot of folks, get in my group like, hey, why aren't you buying Tesla right now? Why aren't you buying Apple right now? It's like, because I have all the shares that I want. I only want super stupid discounts. Or why is your price target so low on particular stocks? Well, it's because my position's full and I just want bonus shares. So I want them on discount, and in some cases, significant discount. And that's the reason why my price is so low. If I'm never able to buy another set of shares, never able to buy shares again in Apple or Tesla or whatever, I'm happy. I have positions full belt out. I don't need any more. Now, and I know anyways that Wall Street's going to eventually get stupid again, and I'm going to get an opportunity again. Now, whether it's this year, next year, 3 years from now, who knows? But I know that I will get an opportunity at some point in time with those great stocks. So for me, that's exactly how I handle it. That's called a modified DCA. That's how I use it, and that's exactly what I'm doing for Palantir here. And if you want to see my watch list with price targets, to include my price target for Palantir, Tesla, Apple, all those, and you want to take 5 courses for free, see all my buy and sell alerts in real time, get access to the best Discord group out there, have access to me anytime you want. I mean, you slide into my DMs, jump on all our Q&As, and we got a ton more coming, to include a stock analyzer tool and a lot of other things like that. That tool's coming and the membership price is going up, but if you lock in your price right now, you don't have to pay that higher price in order to get to use the tool. You get to keep that price, whatever the price is that you have, for as long as you stay a member. So even if we go up to $100 a member, you get to stay right there at the price that you're at right now today and get to keep that price and get access to all the tools we have now and the tools that are coming in the future as well for that same exact price. So make sure you check out the pinned comment down there and see if a membership's right for you. And click this video here if you want to see the stocks I'm currently buying, and click here to see my exact plan during this market. So thanks for watching, and we'll see you in the next one.